Welcome to today's Explainer, where we're going to dive deep into the hidden plumbing of the global financial system. We are going to uncover exactly how catastrophic market collapses are, well, actually prevented. We hear about market crashes all the time in the news, right? But what we rarely see is this incredible, highly engineered fortress working behind the scenes to keep the whole system from just completely melting down. So picture this. Imagine the absolute biggest player in the market just going bankrupt overnight. We're talking massive, multi-billion dollar defaults. Would that trigger a chain reaction that wipes out your personal portfolio? Or is there an engineered system designed to stop it dead in its tracks? Today, we're answering exactly that. We're looking at the very real, very robust safeguards that were forged right out of the ashes of past financial crises. All right, here is our roadmap for today. We'll start with the market's last defense, move on to the default waterfall and skin in the game, explore the math of finding tail risk, look at stress tests, and finally, wrap up with historical defaults to see what actually happens when the shield breaks. Okay, Section 1. The financial market's last defense. This is the core shield of the system. Let's start with the ultimate shield in the financial markets. This is a regulatory infrastructure that was really born from the ashes of the 2008 crisis. Back then, banks had these massive, direct exposures to one another. So if one failed, they all toppled. It was a complete house of cards. The G20's solution to this was mandating the use of a central counterparty, or a CCP. Now notice how a CCP steps right into the middle of a trade. It literally becomes the buyer to every single seller, and the seller to every single buyer. By doing this, it acts as the ultimate shock absorber. It heavily reduces bilateral credit risk and stops those terrifying systemic chain reactions before they even get a chance to start. Moving on to Section 2, the default waterfall and SITOG. Let's look at these layers of market protection. Let's see how this all builds into an actual multi-layered defensive fortress when a clearing member defaults. The industry calls this the default waterfall, and it's basically a highly structured sequence of defensive modes. If a bank goes bust, the CCP doesn't just run around panicking. First, step 1, they burn through the defaulter's own posted margin. That's basically the initial security deposit they use to open the trade. If the losses keep growing past that, we hit step 2, the CCP's own capital, which we call skin in the game. Now, if the fire is still raging after that, we reach step 3. This is a mutualized default fund paid into by all the other surviving healthy members. And finally, if things are truly apocalyptic, step 4 kicks in. These are emergency assessment powers, which essentially means demanding more cash from the survivors just to keep the lights on and the system alive. Out of all of those, the absolutely crucial point is step 2, skin in the game, or SITG. You might be wondering, why does the CCP have to put its own money on the line before touching the community fund? Well, it acts as a brilliant psychological anti-moral hazard mechanism. Think about it for a second. If the CCP had zero of its own money at risk, they'd be super tempted to just lower margin requirements, right? Bring in more trading volume, earn more fees, and just dump all the extreme tail risk onto the community fund. Skin in the game forces the generals to stand right on the front lines. They face direct financial penalties if their risk models fail. It ensures they enforce strict, prudent margin models. It's kind of like forcing the engineer of a brand new roller coaster to ride in the front seat on its maiden voyage. You better believe they're going to double-check the math on that. Now check out the Basel III formula here. And hey, don't let the math intimidate you. The core concept is actually brilliantly simple. Notice how the initial margin, the IM, and the default fund, the DF, are actively subtracted from the gross exposure. This mathematically proves that when a CCP builds a massive defensive moat, it directly lowers the capital requirements for commercial banks all over the world. Stronger CCPs literally mean cheaper capital for everyone else. It's just a beautifully aligned incentive structure. Let's move to Section 3, finding tail risk, VAR and ES, the math of anticipation. Let's shift gears a bit and focus on the architects of this shield and the frankly complex mathematics they use to calculate exactly how thick these defensive walls need to be. To predict financial market weather, risk managers basically use 3 primary contenders, and they're always balancing speed against the ability to capture those extreme, heavy-tailed disasters. First, you've got the parametric method. It's fast, low complexity, but it is terribly blind to extreme events. Then you have historical simulation. It's decent, but it relies purely on past data. So if a disaster hasn't happened before, the model just literally can't see it coming. Finally, there's Monte Carlo simulation. This gives you excellent capture of complex risks, but the computational cost is absolutely astronomical. You need supercomputers humming for hours just to calculate tomorrow's risk. Plus, you always risk entering the wrong parameters. Now, there is a fundamental mathematical rule at play here called subadditivity. Basically, it just means that the risk of a combined portfolio shouldn't be greater than the sum of its individual parts. I mean, that is the whole point of diversification. But incredibly, the old standard risk model, which was called value at risk or VAR, actually violates this rule during extreme heavy tail market crashes. It's like having a thermometer that suddenly tells you a cup of warm water mixed with another cup of warm water is boiling hot. It completely defies economic logic. Expected shortfall, or ES, which is our new disaster barometer, perfectly obeys this rule. It calculates the average of all losses beyond a certain threshold, giving us a much truer, more logical picture of the actual tail risk. This mathematical flaw was a huge deal, and it prompted a massive regulatory shift. The Basel III Fundamental Review of the Trading Book, the FRTB, forced the entire industry to shift from a 99% VAR standard to a 97.5% expected shortfall standard. Now, I know 99% sounds much safer than 97.5% on paper, right? But in the chaotic real world of thick-tailed financial meltdowns, expected shortfall actually forces banks to hold much thicker, much more realistic capital buffers for those severe extreme events.
Section 4. The Black Swan Killer. Stress tests and preparing for the impossible.
But here's the thing. Math alone is completely useless against monsters that have never actually appeared in history before. What happens when you're treating an asset that just doesn't have 12 months of clean historical data? Well, under the new rules, these are classified as non-modelable risk factors, or NMRFs. You can't just casually plug them into your daily algorithm, and that is exactly where forward-looking stress tests step in. Risk managers essentially have to act like financial doomsday preppers. They invent extreme but plausible scenarios. Think things like a total global liquidity freeze, a sudden sovereign debt collapse, or an unprecedented energy shock. And they literally force the banks to hold capital specifically for these nightmares. They are the ultimate what-if survival drills. Finally, Section 5, Collapse Records. What happens when the shield breaks? To truly understand these defenses, we really need to examine the intense breaking news moments where theory met reality and the shield actually cracked. Take a good look at this number, 114 million euros. This staggering loss happened during the 2018 Nasdaq Einar Aas default. Einar Aas was this top Norwegian power trader, and he was holding a massive, highly illiquid spread between Nordic and German power futures. When a totally bizarre weather event caused those two prices to diverge in a way the margin models thought was absolutely impossible, he defaulted. Because the position was so illiquid, one single trader violently drained 2/3 of the entire clearinghouse's commodity default fund. Let that sink in. One trader. It was a massive wake-up call to the industry about the sheer danger of concentration risk. But let's contrast that slow, agonizing liquidity death at Nasdaq with the 2013 Hanmag disaster at the Korea Exchange. In the case of Hanmag, a simple fat finger algorithm error, literally a typo in the code, triggered 36,000 incorrect orders. It caused a massive $39.6 million loss in just 2 minutes. It was so fast and cut so deep that it instantly vaporized Hanmag. It pierced straight through the waterfall, immediately forcing global clearing banks to mutualize the damage. Two completely different disasters, right? One a slow bleed of illiquidity, the other an instantaneous technological heart attack. But both prove exactly why this waterfall has to be totally bulletproof. I want to leave you with this final, truly provocative thought about what we in the industry call wrong-way risk. Imagine a clearinghouse collects billions and billions in default funds from its members to keep the system safe. But by law, they have to deposit that cash into a commercial bank. Well, what if the bank that goes bankrupt is the exact same bank holding the safety fund? If the very mutualized defense funds designed to save the financial system are stored inside another fragile interconnected bank, are we truly protected? Or are we simply waiting for a bigger storm? Think about that the next time you look at your portfolio. Thank you so much for joining me on this explainer, and I'll catch you next time.